The world's most successful investor, Warren Buffett, has been making investments for a very long period. He began when he was just 11 years old and he's now 90 years old. Thus, we may benefit from 79 years of financial experience. And over the years, he has both made and witnessed many mistakes that the typical investor makes. In this video, we'll talk about 8 mistakes that every investor makes by Warren Buffett. But before that, make sure to subscribe to the channel and hit the bell icon for more amazing content. Let's start with the video now without further ado. Number 8. Not understanding the investment. Warren Buffett, one of the most successful investors in the world, advises against making investments in businesses whose business strategies you are unfamiliar with. Building a diverse portfolio of exchange-traded funds or mutual funds is the best method to avoid this. If you decide to invest in particular stocks, be careful to fully comprehend the businesses those stocks represent before you make a purchase. When investors are drawn to the most recent hot industry but have little or no knowledge of the business or sector, without conducting adequate research, you run the risk of losing your hard-earned money, especially if you're unaware of the company's financial stability. However, you have a built-in advantage over most other investors when you investigate and comprehend a business and its industry. You might not understand the nuances and complexity of the company in question if you make investments outside of your area of expertise. This is not to imply that you must be a gold miner to invest in gold mining firms or a doctor to invest in healthcare, but thorough due diligence is essential. You may also want to consider hiring a financial advisor to assist you. Number 7. Not investing. The most common error a novice investor may make is to refrain from investing. Unfortunately, most of us won't be able to save enough for retirement because it's so expensive without a lot of assistance from the stock market. Imagine setting aside $250 per month from the time you are 25 years old until you're 65 years old and ready to retire. You would only have $120,000 when you retire if you kept that money in a savings account that does not earn interest. And you won't likely have that for very long, regrettably. Imagine though if you had put that money into a stock market and allowed it to grow so that you can earn interest on your interest. The Securities and Exchange Commission (SEC) reports that the stock market has historically returned around 10% annually. By retirement, you would have more than $1.4 million thanks to your $250 monthly commitment. By investing in the stock market, as opposed to a non-interest-bearing account, you may dramatically increase the same amount of money you contributed throughout your life. In times of market volatility, it's critical to keep in mind that investing is a means of achieving your financial objectives. Even while there are risks associated with an investment, such as market drops, not investing can also put your financial future at risk. Finding the right balance and accepting just the right amount of risk can help you realize your long-term objectives. Number 6. Lack of patience. Long-term returns will be higher when portfolio growth is gradual and steady. A portfolio should only be used for the purposes for which it was created. Any other use would be disastrous. This means that you must maintain reasonable expectations regarding the pace of portfolio growth and return. Lack of patience is another error investors make. Stocks may not immediately enjoy the intended gains if you're investing long-term. It could take months or even years for a company's management team to implement a new strategy after it is announced. Investors purchase stock shares all too frequently and then want the shares to work in their best interest right away. For instance, between 2000 and 2021, the larger S&P 500 index produced an average yearly return of 9.01%. This shows the 5 years the index had a loss, including the 36.5% decline it saw during the Great Recession of 2008. The power of compounding is frequently what makes investing profitable. The best returns are frequently achieved by people who begin saving for retirement while they are young, since compounding takes time to truly take effect. Number 5. Letting your emotions rule. Emotion is arguably the biggest detractor from investment return. Fear and greed indeed control the market. Investors shouldn't let greed or fear influence their choices. They should instead concentrate on the greater picture. Over a short time horizon, stock market returns may vary greatly, but over the long term, historical returns often favor patient investors. In actuality, as of May 13, 2022, the S&P 500 has generated a return of 11.51% over 10 years. The year-to-date return is at minus 15.57%. When faced with this kind of negative return, an investor who is driven by emotion may panic and sell when, in reality, they would have been better off keeping the investment for the long run. In reality, patient investors may profit from other investors' foolish choices. Number 4. Learning about stocks from the wrong places. Another frequent and expensive investing blunder is obtaining stock recommendations or information from incorrect sources. There is no shortage of so-called experts prepared to share their thoughts while presenting themselves as knowledgeable and always right. Even stock analysts who work for investment firms make mistakes while frequently having a thorough understanding of the company and the sector they cover. In other words, even if someone is qualified to express an opinion, they can be incorrect. For broad investment advice or direction, government-backed sites and non-profit organizations are typically smart places to start. A financial advisor could also help you to navigate the procedure. Even the most successful and knowledgeable investor cannot accurately forecast the future. Consider it a warning sign if an investing advisor promises you a specific result from your investment. Number 3. Averaging down. When investing, averaging down might be an expensive error. Typically, investors who have already made a mistake and need to make up for it will average down. For instance, if they acquired the stock at $3.5 and it falls to $1.75, they may decide to buy more shares at a lower price to hide their error. As a result, their average price per share is significantly lower as a result of their recent purchases of the stock at $3.5 and additional shares for $1.75, which makes their actual loss appear much smaller. Averaging down can also be viewed as pouring good money after bad, since you are adding more funds to a losing deal by purchasing additional shares of stock that have decreased in value. On the other hand, buying more shares after the stock price has increased, indicating that you made a wise decision, is known as averaging up. Averaging down is generally not preferred by short-term investors who invest only in stocks rather than in companies. They search for buy and sell signals based on a variety of indicators that go along with trends as opposed to breaking them. Averaging down is probably not the best method for you if your only objective in the trade is to earn money and you have no actual interest in the underlying company other than how market, news, or economic events can affect it. The reason for this is typical that you don't know enough about the underlying business to tell whether a price decline is transient or indicative of a significant issue. Number 2. Putting all your eggs in one basket. When you place all of your financial future eggs in one basket, a single bad development can ruin your entire portfolio. By diversifying your investments, you can lower your risk and lessen the likelihood that your entire portfolio will suffer if one of them performs poorly. You may diversify your investments by holding a mix of stocks, bonds, and real estate. For instance, the bond market might do well and assist you to cut your losses from equity investments if the stock market crashes. Purchasing stock in several businesses operating in the same sector is another approach to diversifying. Additionally, you can purchase several sector funds, each of which focuses on a specific area like technology or finance. You can easily diversify a portfolio with just one investment by investing in index funds, mutual funds, or exchange-traded funds. Number 1. Expecting too much from the stock. Overestimating a stock's potential return is another mistake investors make, and this is often the case when purchasing penny stocks. Low-cost equities may resemble lottery tickets, enabling a $500 or a $2,000 investment to grow into a modest fortune. With penny stocks, there is a high risk of loss, so investors who anticipate a small, underperforming company to outperform its competitors may be let down. It's critical to have a reasonable expectation of the share price performance of the company. Examine the stock's previous performance and make a decision based on the company's financial performance as well as its historical patterns and gains. Even though historical performance cannot predict future outcomes, it might be a good place to start because it sheds light on the stock's volatility and trading activity. The market will penalize you if you have unrealistic expectations, but if you keep your expectations low and concentrate on improving yourself, it will reward you greatly. I don't know why it works, but I have conducted enough testing to draw that conclusion. It might have something to do with nerves or another factor that I'm unaware of, but anyways, it just dang works. The next stage is to learn both the procedures of investing in the market and trading in the market, and then choose the one that best suits your type of thinking. Once you have very little expectation from the market, give your time and money to educate yourself on the option you find most appealing, then implement it on a very limited scale. The scale should be so little that losing it won't be a problem. Work on the procedure as you go, then scale it up to a level at which you're comfortable after it starts to work for you. That's it, guys. These were the 8 mistakes that every investor makes by Warren Buffett. If you like this video, make sure to subscribe to the channel and hit the bell icon. Leave a like, share it with your friends and families, and jot down your thoughts in the comment section below.